Welcome, curious minds, to another deep dive.
Great to be here.
Today we're tackling one of finance's, well, great riddles, really. A question right at the heart of our retirement accounts, our investments.
The whole global economy, basically.
Exactly. You know, something like half of all Americans have money in the stock market.
It's huge.
So for something so impactful, you'd think we'd have it all figured out, wouldn't you?
You would think, but nope.
Here's the paradox. Economists still can't quite agree. Are markets, truly rational, efficient, like a finely tuned machine?
It's processing everything perfectly.
Or are they messy, chaotic, unpredictable, driven by, well, human whims and emotions?
It's a fundamental clash of ideas, been debated for decades.
Absolutely. Titans clashing.
And that's exactly the intellectual battlefield Andrew Lo wades into with his really groundbreaking adaptive markets hypothesis.
Okay, Andrew Lo.
Yeah.
Oh.
And what he does, quite brilliantly, I think, is he doesn't just pick a side. He doesn't say, okay, markets are rational or no, they're irrational.
He finds a third way.
Sort of. He offers a completely different lens. He suggests looking at finance not as some rigid machine or pure chaos, but as an evolving ecosystem, like nature.
An ecosystem. Interesting. Like biology.
Precisely. It's a way to help us grasp why markets act the way they do, the ups and downs.
And for you listening in, getting this concept's like a shortcut, isn't it? To making sense of market behavior that can seem, well, totally bewildering sometimes.
It really clarifies things.
It's the kind of idea that gives you those aha moments, like, oh, that's why that investment strategy suddenly stopped working.
Or why bubbles inflate like crazy and then pop.
Exactly. So our mission today in this deep dive, let's first unpack those two big ideas, the efficient market hypothesis.
It's a rational machine view.
Right, and behavioral economics.
The human whims view.
And then we'll show how Lo's adaptive markets hypothesis kind of masterfully brings them together.
Synthesizes them, yeah.
So by the end, you'll have a more thorough but still quick grasp of these dynamics, ready to navigate things with a fresh perspective.
Sounds like a plan. Let's dive in.
Okay, so before Lo, what was the main idea? The gold standard theory.
Right. For decades, the really dominant force was the efficient market hypothesis. EMH for short.
EMH.
Heard of it? It's an incredibly elegant concept, almost beautiful, really, in its simplicity.
Okay.
Its core claim: prices already reflect all known available information instantly.
All information, like everything.
Think about it. News reports, analyst forecasts, economic data, even rumors. It's all supposedly baked into the price of a stock or whatever asset, like right now.
Wow. So EMH is definitely the finely tuned, predictable machine side of things.
Absolutely.
But if prices already have all the info, what does that mean for, say, me, the average person trying to invest wisely?
It means that by the time you hear a hot stock tip, supposedly,
Yeah.
the market's already counted for it, the price already reflects it, trying to consistently beat the market using public data, EMH suggests it's basically impossible, like trying to catch smoke, as you said.
Right.
This is the semi-strong form of EMH. It suggests even the pros, the analysts, can't consistently win just using public info.
That's huge. So active management, picking stocks, kind of pointless.
Well, according to strict EMH, largely futile, yes. For decades, that was a very influential view.
If prices reflect everything, trying to outperform through skill or research, it's just luck. Or taking on more risk, not actual insight.
That's the logic.
And this thinking, it shaped so much, didn't it? Retirement funds, trading desks.
Oh, definitely.
It led to the rise of passive investing, index funds. If you can't beat the market.
Just beat the market, exactly. It seems perfectly rational, at least on paper.
Yeah, on paper.
Precisely. EMH painted this picture of investors as, well, perfectly rational, logical, always optimizing returns, no emotion, no bias.
Like financial robots?
Almost, yeah. Like an idealized science experiment. It gave a strong framework for how markets should work, ideally. Very compelling, very clean.
But we all know that perfect rational world doesn't always match reality, does it?
Not quite.
And that's where behavioral economics comes in, right? Shaking things up.
Absolutely. It threw a wrench in the works of that perfect machine idea.
This is the other side of the paradox, the unpredictable human-driven market. Behavioral folks looked at how real people make decisions.
And found it's messy.
Messy is a good word for it.
Yeah, I mean, this is where the human element really crashes the party. Behavioral economics showed, with actual evidence, that people often stray far from perfect rationality.
Give you a good example.
Sure. Think about biases like anchoring. During an IPO, that initial price talk, it heavily influences how people value the stock later, even if new info comes out.
Ah, right. You get stuck on that first number.
Or herd mentality, everyone rushing into the same hot stock just because everyone else is.
FOMO, fear of missing out.
Exactly. These aren't small things. They can genuinely distort market prices, push them away from fundamental value.
So EMH saw the market as this perfect calculator. And behavioral economics basically said, hold on, who's using the calculator? And are they even punching in the right numbers?
That's a great way to put it. I mean, look at the 2008 housing crisis.
Oh, yeah.
Rationally, people should assess a home's value, their ability to pay, the risks.
Yeah.
Instead, we saw euphoria, a widespread belief that prices could only go up forever. Everyone piled in.
Herd mentality again.
Absolutely. Driven by greed, maybe fear of missing out, clearly not purely rational calculations, especially when big emotions are swirling.
You nailed it. Or think about, more recently, meme stocks.
Oh, definitely.
Companies with shaky finances, suddenly their stocks go to the moon, driven by social media hype, not earnings reports.
A massive online social experiment playing out in the market.
Right. These things just scream that, okay, the information might be out there, but our human psychology can totally override how we interpret it.
Leading to bubbles that just defy traditional logic.
And then, pop, the inevitable crash. It's a powerful counterargument to that perfect, efficient machine idea.
And the key takeaway from behavioral economics wasn't just finding flaws in EMH. It offered a different, valid way to look at things. It emphasized the psychology.
The human factor.
Exactly. Moving away from the abstract rational agent to the actual, sometimes illogical person making the choices. It helped explain why bubbles happen, why markets overshoot, why irrational exuberance is real.
So for ages, it felt like this binary choice.
Right.
Rational or irrational. Efficient machine or human chaos. Night or day.
It did feel like that. Pick a camp.
But then Andrew Lowe arrives with his adaptive markets hypothesis. And for me, this is where it really starts to click. It just feels intuitively right.
It resonates, doesn't it?
Yeah. He doesn't say one's right and one's wrong. He kind of weaves them together.
That's the elegance of it. He borrows, as you guessed earlier, from biology, from evolution.
Okay, back to the ecosystem idea.
Exactly. Just like species adapt to survive in their environment, investors adapt. Financial markets adapt. It's dynamic, not fixed.
So investors aren't always logical or always emotional.
Right. We're not locked into one mode. Sometimes, yes, cold, hard logic dominates our decisions.
Like the EMH world.
And other times, instinct, emotion, those deep-seated biases kick in. It depends on the situation, the environment.
So this adaptation, how does it show up in the market? Does it just flip-flop between EMH and behavioral finance? Like a switch?
Not quite like a switch, more like a dimmer maybe, or a spectrum. Lowe's hypothesis says markets aren't always efficient nor always irrational. They shift, they adapt.
Like a chameleon, changing colors.
Good analogy. In stable times, calm periods, when information flows smoothly, volatility is low.
Things feel predictable.
Yeah. The market tends to act more efficiently then. Prices adjust quickly. It's harder to find those easy wins. The EMH seems to describe it better because the environment favors rational thought.
Okay, that makes sense. Our rational brain has space to work when things are calm. But what about when things get, crazy?
Oh, well, that's when the behavioral side kicks in stronger. When the environment shifts dramatically, a crisis, huge uncertainty, some disruptive new tech.
Stressful times.
Exactly. That's when our instincts, our fight or flight responses can take over. Fear drives panic selling. Greed fuels bubbles.
So the market itself adapts.
The whole system adapts. The players, their strategies, the market structure, they all adjust to the new reality, sometimes in very unpredictable ways. Law's framework lets us see this ebb and flow between rationality and emotion as natural.
That offers some really powerful ways to think about things, like value investing.
Go on.
It worked for decades, right? Buying undervalued stocks. But then it struggled after the dot-com boom, when tech stocks soared without traditional profits.
Right.
AMH helps explain that. Not as a failure of value investing logic, but as the market adapting to a new kind of information environment, new types of companies.
It's the ecosystem changing.
Yeah. And it makes sense of bubbles bursting not as weird anomalies, but as a natural result of us adapting and interacting in a changing system.
Oh, and here's a big one, financial regulation.
How so?
Well, if markets adapt, regulation can't just be static, can it? One size fits all probably won't work. That's a critical implication. If markets are constantly evolving new tech, new players, new behaviors, then our rules, our tools for managing them, they have to evolve too.
Right.
A set of rules designed for yesterday's market might be useless or even harmful in today's faster tech-driven world. We need dynamic regulation, not just fixed rules set in stone.
And what I find really compelling about adaptive markets is how it kind of humanizes finance.
Yes, I agree.
Instead of pretending investors are robots,
Yeah.
it accepts that real people bring all their stuff, emotions, psychology, gut feelings into money decisions.
It validates that messiness we talked about.
Exactly, and makes it part of the system, not some weird error. It acknowledges we're human and that influences finance.
Fundamentally. So stepping back, what's crucial here is seeing markets aren't always efficient, but they aren't always irrational either.
They shift.
They shift. It's not a perfect machine. It's a living system.
Yeah.
This deep dive into Lowe's work really drives home that finance is this complex ecosystem adapting to change.
Constantly moving between efficiency and irrationality.
Depending on the environment, right? Stable times, crises, new tech, just shifts in collective mood. It all plays a role.
So wrapping up, what does this all mean for you, our listener, whether you're deep in the markets or just thinking about your savings?
Well, first, this view humanizes finance. It acknowledges real people, real emotions, real instincts matter.
It's not about judging people as irrational, but understanding these are just parts of how the system works.
Absolutely.
And here's the kicker. If markets evolve, if they adapt, then we need to adapt too.
Our strategies, our rules, our tools.
They all need to evolve. We can't just stick to one old playbook forever.
And connecting that to the bigger picture, Lowe's adaptive markets hypothesis is a good reminder, isn't it? Instead of this endless hunt for the single, static, right way to invest or regulate.
Like finding the Holy Grail.
Yeah. We should probably embrace the fact that these systems are inherently dynamic, always changing.
It demands flexibility, observation, constant learning, being ready to adapt our own thinking.
Well said.
So this deep dive into Andrew Lowe's adaptive markets, it offers a really powerful lesson.
That in money, just like in life,
Adaptability may be the ultimate edge.
adaptability is key.